Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Beech Financial Group. Gentlemen, how are you today?
Doing well, Eric. How are you?
Doing very well, Eric.
Doing great. It's been too long since we've spoken. I know that the last couple podcasts you guys did were on special needs planning, and they were fantastic. So anybody who hasn't heard that, maybe they're joining us for the very first time, you've got to go back and check out those podcasts. You blew me away. It was great information, great guest. Thank you so much for doing those.
Yeah, it was a lot of fun.
And Mike's outstanding. He's just a colleague that just is a superstar in my world.
Yeah. And Michael, I know today we're talking about some planning in 2020 specifically. This is very timely. But what kind of planning are you talking about today?
Yes, this is very timely. So the topic we wanted to talk about today is really taking advantage of sort of where we are today in 2020 and utilizing it's more of an advanced estate planning strategy that is typically used with any asset that you feel is going to grow or appreciate in the future. And it involves a type of trust, an irrevocable trust called a intentionally defective grantor trust. So we're going to talk a little bit today about how to utilize that trust in planning, why right now with where we are in the world, this trust is probably Dad, I think you would maybe agree, probably the best time, at least in my career.
The stars are lined up.
Yeah, that I've seen to use this strategy. So that's what we're going to talk about today. It might get a little bit technical.
We apologize ahead of time.
But this is a complex and technical strategy, but I hope we can communicate in an effective manner and deliver some value today.
Well, for every listener, I hope you've gathered by now from the podcast you've heard before this that John and Michael, you're both very open to people giving you a call. So if you do get technical, if you're listening to this thinking, man, this sounds interesting, I just don't understand it fully, please reach out. We will give contact information at the end of the podcast so that you can do that. Michael, this is the most interesting name of a trust I've ever heard. I've never heard this before. Can you say that one more time?
Sure. It's called an intentionally defective grantor trust. The defective name, which is, I think, by the way, a terrible part of a name because it sounds like it doesn't work. But
it's broken.
It actually can work very well.
Okay.
but that this type of trust is, and the reason why it's called a defective trust, it's an irrevocable trust, and normally irrevocable trusts are their own taxpayer. So similar to a corporation or an individual that has their own tax brackets and tax laws, trusts are normally the same way. This type of trust it has certain language in it that allows it to be what they term defective for income tax purposes. So all that means is that the grantor of the trust, who's the person that creates the trust, and the trust itself are really one and the same taxpayer. So that allows the grantor of the family to transact business with the trust without paying any income taxes on those transactions, and that'll come into play when we get into a little bit more detail on the strategy. But that's where the term defective comes from.
Yeah, by the way, why it's complex, just to throw in my thoughts, is because the tax code's complex. So all the things we've talked about in the past on these designs are designed through the tax code to make sure we take advantage of every step we can in the code to give benefit to the family from a legacy standpoint or transferring wealth generationally. So that's the focus of this trust.
All right.
Yeah, so let's, Dad, maybe you and I can both talk about sort of where we are today. And again, I think this timing of this is very important and why this strategy can be maximized in today's day and age. But if we look at sort of where we are with COVID, so right now we're still in the COVID world. We hope that we're not in COVID world very soon, but we are in COVID world now. And one of the things that we see from our families and from a lot of the business owners that many of our colleagues work with is that many industries are struggling right now. Due to COVID, their revenues are down, their valuations are down, and while that seems like, and it is a challenge, and is not a positive challenge, it actually, for this strategy and estate planning, does create additional opportunities. And the reason for that is when we can look at this strategy, having a lower valuation is actually a benefit. So that is reason number one why timing is important. And we could talk a little bit more about that as well. But Dad, maybe why don't you also touch on sort of where interest rates are today, because I think that's also an important component that makes this transaction really beneficial right now.
This is one of the other stars that's lining up, and it's around the interest rate environment. If you look what's occurred over the last probably 20 years, rates have come down substantially, and they're probably the lowest right now that we've ever seen. So this strategy that we're talking about takes advantage of those low rates along with the valuation discussion. And to add to Michael's valuation point, and I'll make an analogy. If your company's worth $10 million before COVID, and because of lack of growth and because of the COVID issue, it's now worth $5 million based on projections. To Michael's point, that's a good thing. And we could even discount it further, and we'll let Michael get into that in a second. The discounted interest rates, the valuation discounts. There's a third piece, which is the estate tax change. Now, if you understand the estate tax code on the tax side, there's a credit we all have. And if you remember from previous podcasts, that sits at roughly $23 million per family, husband and wife. Mm-hmm. That means they can take $23 million worth of assets and push them down to the next generation without that next generation paying any tax on that inheritance. What's changing in 2026 is there's a sunset provision in the code that says it's now sitting at 23 million, probably around 24 million at that time. It's now going to go back to the original structure before the law in 2017 changed it. It's going to go back to 11 million. So there's a $11 million credit that we want to take advantage of for other assets, not for this particular trust, but it's part of the equation where we look at how do we leverage moving assets either through gifting or sales of assets to these type of trusts. So I want to make sure we cover that. It's just a perfect opportunity for anyone who has a asset that they think is going to appreciate dramatically to get that out of your estate today and get it into trust, because once it gets into that trust and it's structured properly, you'll never have to pay any tax on any growth of those assets until perpetuity if you so choose. So there's a lot of legacy discussion we have in this design. The families have to be focused on that. I want to create a legacy for my family and through the generations. If you're not really interested in that, then this option might not be very attractive or an attractive option to consider. But for people that have a legacy issue and want to pay less tax on those assets as they pass generationally, this is a great concept.
Yeah, and you mentioned the credit, the lifetime gift and estate tax credit, and that was really important to bring up, Dad, because one of the hallmarks, we call it, of advanced estate planning is being able to use that exemption amount efficiently. So the higher it is, typically the easier it is, obviously, to get assets out of your estate within that credit, because if you gift assets above that credit, under current law, your children, essentially, if you were to pass away and leave them more than that credit, they will pay 40 cents on every dollar above that limit or that threshold. So using that threshold becomes really, really important, which is why for certain businesses, even though it's not a good thing that COVID has maybe harmed your business and its growth, the fact that you could, if you valued the company today, and it would value in or come in less than it otherwise would pre-COVID, that actually can be a benefit because you're using less of that exemption. So it's somewhat counterintuitive in terms of why it's a benefit, but that's the reason why. It's all about efficiently using that exemption as best you can. So that's why it's important from a timing standpoint, because again, we have this higher exemption for the next 5 years if nothing changes in the law, which brings up the elections in 2020, because that's another issue that could affect the efficacy of this strategy, because not to be political, but if Biden gets elected, if you look at his tax proposals, it's one of the highest, I think, or greatest tax raises that I think almost maybe any president has had. I think it doubles what Hillary Clinton was proposing from a tax raise just 4 years ago. So that could have a really big impact on your ability to use this strategy, depending on whether he gets elected and what he's able to put in place tax-wise.
Yeah, I want to back up on I know the listeners are probably saying, well, I'm not that rich and I don't have those kind of assets to worry about the tax. And you're probably right. This trust strategy, you don't have to be real rich to do this. This is a strategy that you could put really anything in. You can sell anything in this trust. It could be a piece of real estate. It could be a small business. It's just really understanding that you can really move assets generationally and take advantage of the tax code and protect those assets as well for the family to never be taxed. Because what people miss a lot in planning, they look at an asset today and it's worth $1 million. Well, if you invest it properly and you grow that asset tax efficiently, that $1 million will probably be worth $20 million in 40 years. So the growth of these assets are critical in these trusts. And so that benefit saves all those tax exposures that Michael just talked about.
Right. So let's maybe get into sort of with that groundwork or that foundation in place. Maybe let's talk about the actual transaction itself. So we talked about having this lower valuation potentially depending on your business and in its industry. So how this transaction works is you would have the business valued. Now, one step you can also incorporate here is the creation of voting and non-voting shares in your business. It's called a stock recapitalization. This, again, getting a little technical, but what this does is actually it gives you the ability to further discount the company value by creating non-voting shares. And under the tax laws, non-voting shares are not worth as much as a voting share. And the reason is because you cannot control the company when you own that non-voting share. So it actually gives you the ability to discount the value even further, sometimes up to 25 or 35% additional discounting on the otherwise lower valuation of the company if you did that today. So that's another step that you can do. Once that gets done, the transaction now becomes selling those non-voting shares to this intentionally defective trust that we started this podcast with. Okay, so in order to do that, you have to get a valuation from a qualified appraisal or appraiser, and then once you get that appraiser, that sale transaction occurs, and that's in structure how that transaction works. I hope everybody followed that there.
Yeah, it sounds a little complicated.
A little bit complicated.
Yeah,
it is. And once you get that transfer or that sale to occur, before you do that, you have to seed it with about 10% of assets. And Michael, you could explain from a tax standpoint.
Yeah. That's a great point. So the other component of this transaction, again, to give it economic substance, is that the trust has to have some assets in it prior to this transaction, the sale transaction occurring. And the logic is that if you were to sell your business to a third party, you're very likely not going to sell that asset to a buyer that has no assets or no ability to pay you other than in a promissory note, which is part of this transaction. Is the business is sold in return for a promissory note. So again, the concept is you're not going to do that sale with a third party to somebody that doesn't have any assets. So in order to give it economic substance, the trust has to have some assets seated in that trust prior to the transaction occurring. And custom has developed over the years that 10% of the ultimate purchase price has to be in the trust to serve as a down payment. So that's what you were talking about first. Now that is typically done via a gift. There's some other ways that some attorneys that we work with have given that transaction economic substance, but you have to have that put in place first. So there are a lot of steps and complexity that comes along with this transaction, which is one of the reasons why we wanted to have this podcast now before the year gets too far along, because there are a lot of things that have to be done if you want to take advantage of this transaction before the end of the year. It's really important to have your legal teams on board, your accounting teams on board, any of your key advisors. It's really important to have them involved in this to make sure that the transaction is done properly.
Now, once the asset gets into the trust, a note gets created. Remember, when you make a sale, you're selling an asset to an entity, you have a note back for that value. And that's where the interest rates come into play. Because when there's an interfamily transaction, which is what this is, The AFR rate, which is the federal rate that the government allows you to lend money to family members, it's the lowest I've ever seen it since I've been in this business. I believe the 1 3-year rate was 34 basis points, Michael.
I think it's even. I think
14
for
basis
October,
points?
I think it's 14.
14 basis points for October. And the terminal loan 3 to 9 years, I think it's 38 basis points in that range. And over 9 years is 1.14 basis points. Or percent, I'm sorry. So when you look at how low these rates are, that means you could do this transaction, and the whole idea is the more money you can keep in the trust, the better, because the trust is designed for that legacy. You don't want money coming back to the family and has to be taxed.
Increases the estate tax exposure
Yep.
if more money comes back out of the trust back to the business owner who's selling to the trust. So the fact that there's those lower interest rates is actually, again, a benefit to the family if the goal is to minimize estate taxes going forward.
So that's why we said earlier that all the stars are lined up for this transaction. So once that transaction occurs, the next step is, how do we unravel this, Michael? Is there a way that we talk about unraveling these trusts? Let's talk about, I know we talked about it in the past, but the benefits of this design is, from a legacy standpoint, has a lot of other themes to it. Why don't you kind of review those?
Well, the goal of this trust and this transaction is to lower the family's existing and projected federal estate tax exposure. By the way, we're talking a lot about the federal estate tax. There are many states out there that have their own estate tax, and this transaction works very effectively if you live in those states as well. So every state's law is different, so you do have to consult your legal advisors on what your state's laws call for. But I did want to point that out. But again, the goal is to lower and minimize the family's estate taxes going forward. So how this transaction, I think we talked about before, is the business is sold to the trust in return for that promissory note. Now, after that occurs, that promissory note that comes back to the business owner is still considered an asset of the family's estate. So when you talk about unraveling the trust, for lack of a better term, really not unraveling the trust, but concluding the transaction is one of the goals typically of the family is to pay that promissory note off as quickly as they can. And the reason is because once that promissory note gets paid off, now it's no longer part of their estate, and the full value of that transaction or that business is inside of that intentionally defective grantor trust out of the family's estate as a gross estate, really forever if you so choose. And that's really typically how a lot of families structure it. Now, another thing which you may be getting at, Dad, is, and it's a common objection we hear from a lot of business owners, is, all right, well, I'm all about saving taxes, but what happens to my access to these assets once they get in the trust? And that's a big objection. So that's really where the design of the trust becomes important. You can have a spouse as a beneficiary of this trust, or you could also have the business owner be the beneficiary of the trust, depending on the design. That's a very specialized version of this trust. But the ultimate goal of this transaction is to lower the family's estate tax, but still maintain control and access to the business after it ends up.
Major conversation.
So that in general is the structure of this transaction. Dad, maybe we can, because we have had a couple families this year that have gone through this, probably more than a couple. I think we have 3 or 4 right now that are going through this transaction. So maybe we could talk a little bit about some of the benefits that they've seen, at least based on our projections, and how effective this transaction could be. You want to maybe talk a little bit about some of those cases?
Yeah, there's actually 2 that we're working on currently. One we're in the middle of, the one we just completed. The one we're working on, it's fascinating. We have a client that has some studios, some gyms, have a lot of value. Because of the COVID virus, they're in California. They haven't even been open yet. So we're able to ratchet down, or we're going to be able to ratchet down these values and make the sale to these trusts. And when we did the math, we had projected this client to have a tremendous tax liability down the road. I can't remember the exact numbers, but it was around $50 million.
Yes, yeah. So that's
if he did nothing.
Right.
In other words, before he met us and we didn't go to this trust structure, he at age 80, if he lived that long and he grew his assets at a reasonable rate, the tax exposure under current tax law would have been about 50 to 55 million in taxes. When we showed him and incorporated this strategy, moving these studios in this particular structure, we projected that his tax only be at $7 million at age 80. So if you look at the magnitude of this design, it saved him probably 90% of his tax liability just by the structure. Still had some exposure at age 80, but as you know, we do a lot of planning along the way with families. We could probably eliminate that tax over time. But based on our projections, it saved him millions in taxes. So now this is a larger client, but this could happen even on a smaller client. You could really create a lot of momentum in these strategies for that tax savings. Plus, it has asset protection. He has access to it. We created an estate bank with this concept, and I know we talked about this in the past, but this client really loved the idea of having this trust full of cash or money along the way. His kids are very young today, but as they get older, they could have access to this trust via borrowing money. Because as Eric and I both know, a lot of the families that we talk to are always concerned about, well, my kids are trust babies, or they're spoiled already, or I want to limit their access. And there's always reasons these conversations occur. But on the brighter side, we could have all the best of all worlds with these trusts. And one of the ones that he liked was having this estate bank concept, where instead of distributions out of the trust, the children along the way could borrow money against the trust and pay the trust back. In essence, they're paying themselves back. But you teach them the responsibility of money and having to pay back a loan instead of just saying, hey, mom and dad left me this trust, and I know I have a lot of money in there, I want it, type of a thing.
Yeah.
So you could really, and Michael will tell you, you could draft these trusts to be very flexible, a lot of options involved to make sure this money's managed properly for the benefit of the heirs. And remember, we're going out generationally. It's not just to the second generation. This might be built for the third and fourth. It's hard to get clients to the fourth generation, to be honest with you, Eric. But they do talk about that as a strategy. But controlling things that long always has a kind of gray area. But if you set it up properly and allow more flexibility in these trusts, it makes it real palatable to a client. And they get to understand the dynamics of, we've taken an asset, discounted the value, took advantage of saving all this tax, put it in this trust structure that I have access to through my lifetime, and along the way, if I pass away with my wife, it's set in place rules and regulations on how kids access this trust.
Yeah, I think you just by going through that transaction, Dad, and I know you've mentioned this, I think we both have or in prior podcasts, but we often term the estate tax as being a voluntary tax, and it's not
Correct.
voluntary technically, but you could see just this is one of those transactions where if you do it properly, you can avoid the estate tax substantially, as we just talked about with that particular family. So these are the types of tools and strategies that we mean when we talk about the estate tax being voluntary. It's because you are allowed to do certain techniques to be able to avoid it, and this is just one of them. There's a whole host of others. So that client that we mentioned, we're still projecting a $7 million estate tax. That's still a big number, right? And if he and his wife and the family wants to get that number down to zero, well, there are a whole host of other transactions and planning tools that they can use to be able to get that value lower or down to zero if they choose.
Yeah, zero tax planning, I think we talked about in the past with some charitable structures. A client could take his $5 million estate, donate it to a charity today, get a full deduction from an income tax standpoint, and live off that trust for his lifetime, both he and his wife, and the kids maybe, depending how you structure it. But upon the death of the last recipient of income, it goes to charity. So the clients look at very unique ways to avoid the tax, and there's probably 16 to 17 versions of how to save tax. But unless you go through that process and discovery, and again, to Michael's point, this is one of the trusts we use for primarily business assets, because that's the largest asset. I think we just did a little bit of a study of our client base, and our clients, 60% of their assets are in privately held companies. That's a big chunk of assets for a family. So that's a focus that we have. How do I get that asset that's growing substantially, control that growth, and get it under in these trusts and get out of the tax man's way?
Yeah, you mentioned charitable planning, Dad. One of the earlier podcasts that we did on Grantor Charitable Lead Annuity Trusts with Derek Myron from Centura Wealth is another tool that families can utilize. If you haven't heard that podcast, Derek did a phenomenal job as our guest, really explaining how that works. But you could pair these two trusts together and really do some pretty powerful estate planning just with those two. So if you haven't checked that one out, I would definitely do so.
And just a warning to the listeners. I mean, these are, as you prefaced in the beginning, these are complex designs. And one of the things we often see is when we present these ideas to some of the families we've had in the past, a lot of the advisors are not qualified in a certain arena to deal with these type of designs. Not that they're not smart people. This is a very unique process. So make sure that if you're interested in this type of a concept, make sure you have a good team of advisors around you that can make this happen. Because if you don't, it's going to be a challenge to do it right. And we always send a shot over the bow. Again, remember our goal as a family CFO is to collaborate with all the clients' advisors to make sure everybody's on the same page. Mm-hmm. So we make sure that the right team's in place when we look at our families, and we kind of guide everyone through these processes.
Yeah, and it is important to have a qualified team. But that is a benefit of us being typically added to that team of advisors, because even if a listener out there maybe has an advisory team, but maybe their advisors haven't come across these strategies before, haven't implemented them before, it could be a really good resource for them to help coach them along, to help educate them, because many of our families have gone through these transactions. And so again, we could just be a good resource for them. That's another benefit of our family CFO role.
Absolutely.
So as you can see, when I guess we're coming to the close,
mm-hmm.
when you look at all these strategies, and we talked about them in the past, a lot of options that clients has. I always have my favorite saying: "You don't know what you don't know." Mm-hmm. This is a perfect example. Until you understand that you have this option, you don't know it exists. So hopefully these podcasts give you a little direction on there are solutions out there that can have huge impact on the family wealth transfer. Even while you're still here, tremendous opportunities for you to create a bucket of value while you're living, and then make sure that value is protected generationally.
Absolutely. And as promised, let's give them contact information in case they want to follow up conversation about this specific podcast.
Sure. You can always call our office. The main number is area code 856-988-8300. Or you could reach us at our website, which is www.cbfgllc.com. That's C as in cat, B as in boy, F as in Frank, G as in girl, LLC.com.
Fantastic. And I like the fact that you mentioned the client in California. Just as these podcasts are nationwide, you guys work nationwide. And so anybody listening to this that has questions, they can go ahead and give you a call, and you're fully ready and equipped to assist them. So I love that. Thank you guys so much.
Pleasure. Thanks.
Thank you.
You bet. And last thank you goes to the listening audience. Thank you for tuning in and listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Securities offered through American Portfolio Financial Services Incorporated, a member of FINRA SIPC. Investment advisory and financial planning services offered through American Portfolio Advisors Incorporated, an SEC-registered investment advisor. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors.
Copper Beech is an unaffiliated entity of American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Any opinion expressed in this forum is not the opinions of American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc., and have not been reviewed by the firm for completeness or accuracy.